Welcome to the Infinite Banking Versus series, where we compare financial strategies to help you make smart money moves. Shout out to Cardi, right? Today, we're exploring the differences between infinite banking and indexed universal life insurance, or IUL. Now, these two strategies often get lumped together, but they're actually not as similar as they seem. So, in this video, we'll be addressing which one delivers the most long-term value and which one has the best financial control. So, you should stick around as we analyze facts, myths, benefits behind both of these approaches.
Today, Jonah, we'll compare these two options using our 8 ideals: guarantees, constant compounding, liquidity, flexibility, privacy, taxes, rate of return, and passive income stream. By the end, you'll know which approach might suit your financial goals best. And don't forget, if you're enjoying this series, go ahead and hit that like button and be sure to subscribe for more insights into different financial strategies.
Now, before diving into the specifics, let's take a step back to understand the origins of both index universal life insurance and participating whole life insurance policies. Knowing their history can really help shed light on their track record and how they've evolved over time.
So participating whole life insurance policies trace their origins back to the mid-19th century. The product was actually pioneered by mutual insurance companies like New York Life and Mass Mutual. These companies provided a model of stability through profit-sharing dividends, making them a real cornerstone of financial planning for multiple generations. Policies from this era weathered major economic crises. To name a few, we're talking about the Great Depression, we're talking about multiple recessions, and numerous wars, really proving their resiliency.
I love that, Shawn. Index universal life insurance emerged much later. So this is in the 1990s. So literally maybe not even as old as you are. Developed as an innovative solution to address some of the perceived limitations by the earlier life insurance products. By tying the cash value growth to the performance of major stock market indices like the S&P 500, IULs aimed to offer a blend of market participation and downside protection. However, with less than 3 decades worth of history, IULs are still actually gaining traction and facing a lot of scrutiny for how their fees and their caps and their participation rates affect long-term growth. So, okay, Shawn, let's start with this Index Universal Life, IUL. This is a type of permanent life insurance, although I do know a couple people who would call this semi-permanent, where the cash value is actually tied to the performance of a stock market index like the S&P 500. Generally, when you're getting an IUL, you actually can pick which indice you'd like your policy tied to. Now, proponents who like IULs, they love the potential for higher returns compared to traditional whole life insurance. They generally highlight the flexibility of premium payments. We can change those. The ability to adjust my death benefit over time, up, down. On the surface, that sounds pretty good, right?
Yeah, I'd have to agree. So far, so good, Jonah. Now, infinite banking, on the other hand, uses a specially designed whole life insurance policy built for the purposes of banking. Unlike IULs, the cash value in these policies isn't tied to market performance, offering consistent, predictable growth. Infinite banking is all about control. You're creating your own financial system where you can leverage your cash value for investments, emergencies, or really any other needs that may come up. Think of it as a tool to help you create financial freedom.
All right, Shawn. So first up then is guarantees. Instead of just taking our word for it, let's actually look at what these insurance companies guarantee. So first up, death benefit. IULs guarantee a death benefit. Well, at least for a while. That seems to drop to 0 on most guaranteed IUL illustrations after a certain period of time. So while the death benefit provides a certain level of security, they also seem to be some inherent risks associated with the cash value component, seeing as the returns are tied to the market. If market returns are poor, the policy holder, that could be you and me, might need to pay higher premiums to keep the policy active, which potentially jeopardizes the sustainability. Additionally, while many IULs offer a minimum guaranteed interest rate for cash value, the floor is often really low, typically around 0%, meaning the growth could actually stagnate in a prolonged bear market.
That's good to know. IULs definitely sound like they have a lot to do with the market. Now, infinite banking policies guarantee both the death benefit and predictable cash value growth. These policies are designed to be self-sustaining when structured correctly, which you want to make sure that's done for you, with no surprise premium increases, meaning the price doesn't change. The price is the price. If you're the type of person who enjoys knowing what's coming and is happy when it's even better than expected, the guarantees for whole life provide might just be exactly what you're looking for.
Compounding in IULs, consistent compounding, is pretty straightforward. Depending on what type of company you're with, either a stock company or a mutual company, and then clarifying whether they are direct or non-direct recognition will tell you if your loans, when you take them, will be recognized. If you're with a non-direct mutual company, then the constant compounding of your policy really won't be interrupted. If you're with a direct mutual company or stock company, whatever it is, then a lot of times when you take the loans, the insurance company has the option to interrupt the compounding. You've got to check in on your paperwork and see what they're going to do.
Yeah, Jonah, this is one of the 8 ideals where IULs and infinite banking are very similar. In infinite banking, compounding continues uninterrupted. Even if you borrow against your cash value, the policy keeps growing as though you never touched it. This is a huge factor in building wealth and definitely something you want to make sure your policy has when it's put together.
Shawn, let's keep moving. Next up, liquidity. Liquidity is one of the key features of both IULs and whole life insurance, specifically infinite banking. This is why these two products get lumped together so often. But the differences in accessibility and impact are super significant. So with IULs, accessing cash value can involve surrender charges, administration fees, especially if you're within the early years of your policy. Loans against the policy's surrender value are possible of about up to 90% sometimes. But you do want to be careful when they're taken out and when they're paid back due to the fact that the policy is tied to the market, and having multiple bad return years coinciding with you taking large loans out of the policy could mean the policy just collapses on itself. So moreover, policies may include restrictions or waiting periods before you can fully access your accumulated value. In short, if you're interested in IUL, you've got to talk to your advisor, and he'll probably tell you, he or she, don't access the cash value, normally around 10 or 15 years. It's normally pretty standard.
Okay, that makes sense. That definitely doesn't seem ideal for the purposes of banking due to some of those wait periods and potential risk. But Jonah, when we're discussing liquidity, infinite banking policies provide unparalleled access, which really makes them stand out in the insurance world altogether. With a properly structured policy, you can borrow against your cash value almost immediately after the policy is funded. We like to say within the first 30 days, but in my experience, personally, it's been much sooner. And as long as you're partnered with a non-direct recognition company, the loans that you take out won't affect the dividend paid to the total sum of your policy's cash value. This makes infinite banking a very powerful tool for managing short-term needs while preserving long-term growth. Whether it's for a business opportunity, an emergency expense, or even a personal investment, the flexibility and liquidity offered by these policies is unmatched.
IULs can be used for a variety of financial goals, such as implementing retirement, buying that new purchase, paying for the kids' college, whatever you want. However, the flexibility of these policies is tied to market-based growth. So what that means is loans from the IUL are possible, but they come with inherent risks. If the borrowed amount isn't paid back in a timely manner and you face a period of poor market performance, the policy could end up imploding on itself due to other expenses involved. We talked about those a little earlier. All in all, it can be used for a lot of the same reasons people use participating whole life, except basically wrap the whole thing in caution tape.
Yeah, I for sure see the similarities, Jonah, but the differences are clearly starting to stand out as well. I think we're starting to see that whole life infinite banking policies excel in their practicality and their flexibility. You see, policyholders can borrow against their cash value, like I mentioned, for any purpose, Whether it's funding a business, covering an unexpected expense, or even paying for college tuition, the key difference lies in the guarantees. Because your whole life policy has a guaranteed growth rate, the policy is, let's face it, it's just more stable when taking loans versus the uncertain gains that come with an IUL.
When it comes to privacy on these two products, they're both life insurance. Insurance policies are privately owned assets in this country. So both products just absolutely check that privacy box.
Yeah, Jonah, I think that's a really cool feature because at the end of the day, who wants all of their business out there if it doesn't have to be? For example, with infinite banking, loans don't require credit checks or any sort of external approval, offering you a far greater level of financial confidentiality.
And when it comes to taxes on these two products, they're pretty evenly matched as well. IULs provide tax-deferred growth, access to tax-free loans, and of course tax-free withdrawals up to your basis amount, which just means as much as you've put in.
Yeah, you could say the exact same thing for infinite banking. Your whole life policy also grows tax-deferred, provides access to tax-free loans, and provides a death benefit that's paid out tax-free, making them both really good vehicles to utilize, specifically when we're talking about the tax benefits.
IUL policies often attract attention for their potential to deliver high returns when the market performs well. However, the caps on the growth, the participation rates limit how much of the market's performance you can actually benefit from. So additionally, policy fees, administrative costs, potential charges, cap rate, all this stuff can significantly reduce net returns even in the strongest of markets. So I would say this is one of the areas that IULs could absolutely outdo whole life insurance and whole life policies and infinite banking because the IUL's focus is more investment oriented. So if you're looking for short-term gains and you're feeling confident in your risk management, then this possibly could be the choice for you. But what you should not focus on here is access to that cash and being able to use it to go ahead and accomplish your goals.
Yeah, Jonah, I can definitely see where there is some appeal there, mostly with the dabbling in the market portion if you're up for some risk. So I guess it depends what you're looking for. Now, infinite banking by design prioritizes steady, predictable growth over those speculative returns, but the cash value in a whole life policy grows at a guaranteed rate, and dividends paid by the mutual insurance companies further enhance its overall growth. Just to be clear here with everybody, dividends are not guaranteed, but partnering with a good company can mean you're backed by a 125 plus year track record of never missing a dividend payout. Not too bad if you ask me. Now, I'm sure you guys have put this together, but because participating whole life has nothing to do with the market, understand that the returns may not match the peaks of market tied investments during what we would call a bull market. But infinite banking policies really shine by offering consistent compounding growth that's completely unaffected by any sort of outside factors. Over time, this steady performance often outpaces the net gains of riskier investment strategies, especially when accounting for those pesky market downturns that seem to be more and more frequent.
Last but not least, Shawn, is passive income or a passive income stream. Now, I want to be clear when I say that IULs can absolutely create passive income through withdrawals and loans come retirement time. But there's a few key factors that we have to mention that have to just be taken into consideration. And one, of course, is you might not make it to retirement time in an IUL. Obviously, you want to make sure your policy has adequate growth, but I just suggest IULs more as like a buffer account and only really pulling the money out if and when you have to fill the gaps. Because remember, if gains are still tied to the market and you're pulling out too much and you've got that bad market return, which of course is going to happen at some point, that could really negatively affect you. And the last consideration you want to make is just to remember that IUL is built on an annual renewing term chassis. That's why some people call this a semi-permanent product, not really a permanent product. What an annual renewable term chassis means is that the older you get, the more expensive the life insurance becomes in and of itself. And the more it's going to actually eat away at your cash value, or the more that you have to pay out of your own pocket to keep the policy alive. So remember earlier when I said a lot of people like IULs because there's some flexibility in how much I pay. The problem with that is the policy itself can ask you for more money, right?
Yeah, you make a great point there, Jonah. And I think it's important to point out that although there are definitely some similarities between these two products, at the end of the day, the potential for risk and your policy collapsing at some point in time, especially during the years that you might need it most, when the cost of insurance has gone through the roof, sounds like an all too real possibility for me. When it comes to infinite banking, passive income is much easier to count on because of the one major differentiating factor between these two products, and that's the yearly guarantees.
Choosing between an IUL and a whole life insurance policy, specifically one built for infinite banking, comes down to understanding financial priorities and your financial priorities. IULs, of course, offer growth potential, but they come with the market risks and policy fees and a yearly increase in the cost of insurance. If you're okay with those things, then that might be the perfect vehicle for you.
At the end of the day, infinite banking focuses on guarantees, it focuses on stability, and it focuses on long-term value. For those of you who like the feeling of control and predictability, this might be exactly what you're looking for. I'll add that when used correctly, you begin to understand that this is just the foundational piece to building your wealth.
As always, we're here to help you decide what's right for your personal situation. If you're interested in chatting with us, here's the instructions. Click the link in the description of the video. Book a call. You'll get myself or Shawn on the other line. We'll help you specifically dive deeper into your overall goals.
Thanks for watching. Please don't forget to like, comment, and subscribe. Let us know what your thoughts are and which of these 8 ideals matters most to you. We'll catch y'all in the next video. Peace.